Hi, welcome to the second part of today's class. We'll cover real options. Let me start by showing you a video by an expert on valuation and real options, Professor Damodaran out of New York University. So here it is.
Pricing. To give you an idea of where the value of an option comes from, let me give you a very simple illustration. Let's assume you have an investment where there's a 50% chance you could make 100 million and a 50% chance you could lose 120 million. The expected value of this investment is negative, right? You would not take this investment. Now let's say I took the same investment and broke it down into two steps. In the initial step, you take it in a smaller increment. So in that first step, you get one of two outcomes. Either the investment comes back as a good investment, in which case you make plus 20 million, or it comes back as a bad investment, in which case you lose 20 million. If you lose the 20 million, you stop the investment right away. But if you make the 20 million, you continue. And if you win, you make another 80 million, giving you a total upside of 100 million. And if you lose another 100 million, giving you a total downside of 120 million. If you look at the probabilities, this investment is actually equivalent to the first investment. There's a 50% chance that you'll make 100 million, and there's a 50% chance, cumulatively, that you lose 120 million. But here's the magic of options. If you take the expected value of this investment, you're actually going to end up with a positive expected value. A bad investment became a good investment when you took it in two steps. Now step back and think about why the second investment was valuable and the first investment was not. The first aspect that made the second investment more valuable is you got that first try. You were able to observe what happened in that first try, learn from it, and adapt your behavior. In fact, those are the two key words that drive the value of real options. It's learning and adaptive behavior. Let me stop being abstract and give you a real-world example. Let's suppose you have to value an oil company. In a traditional discounted cash flow model, here's what you do. You take the expected number of barrels of oil that will be produced each year. You multiply by an expected oil price. You come up with an expected cash flow, and you discount back at a risk-adjusted rate. What are you missing when you do that? If you actually ran an oil company, you would not produce the same number of barrels of oil every year. And here's why. You get to observe the oil price first, right? If oil prices are high, you might produce a lot of oil. If oil prices are low, you might cut back on production. You have the option to adjust production. There's learning from looking at the oil price and adaptive behavior because you change the production that you have based on that price. That's what you're looking for in real options. Is there a capacity to learn, and can I change my behavior to make a business or asset more valuable? So here are the
So we'll go through the case itself as usual. I'll have it on slides here. So I'll be quiet while you read the case description, and then we'll go through the steps and do the exercise together. let me go into fact set to get the inputs. As usual, I'm using online version rather than the app, but it shouldn't really matter. So I have logged in, and then I went into markets, and then under commodities, we have spots, and then natural gas Henry Hub spot price. At the bottom here, you see price history. Click on that. And here, I have it preset, but let me show you the settings that I have. So I'm going into custom, and this is just for the time period. Let me start with 1990. This will give me 30 annual points. Start on August 1st, and then I'll end on end on August 1st, 2020. I'm just interested in annual data points. So here are the 30 data points for natural gas prices. I'll download them in Excel. So let's now copy and paste these prices into the template. So I'll add a separate tab. I'll call it gas prices. So I'll highlight this download from FactSet, Control C, Control V, we'll paste it. We are really interested in change. So right now it's change, column E here, change as a percent. So in 91, the price went down by 10%, but let's recalculate it and double check. So I'll divide the price in 91 by the price in 1990, minus 1, and I'll format it as a percent. So you see this 10.1%, which is the number that we had. So, and then I'll just copy and paste it just to double check. And then we'll run analytics on this column E. So we'll calculate average, change, and standard deviation for the change. So the average is simply the average formula with 30 observations in column E. And standard deviation would be, I'll use this formula, STDEVS. And then I'll just highlight this data set. And then I'm getting the formatted as a percent as well. So I'm getting 28% standard deviation. Now let's populate the inputs. So current gas price. So the latest we have for 2020 for this year is $1.83. And then historic volatility would be the standard deviation. As you see, I'm kind of using my color convention. So the purple is linked to another page, blue is hard code, and then black is the formula. Gas production, this was given in the instructions, 500 million cubic feet. Royalty is 12.5% from the instructions. The drill cost is 2.5 million, so expressed in thousands, this would be 2,500. discount rate, we were given 20%. Net gas sold would be gas produced minus royalty, so multiplied by 1 minus the royalty rate. So net gas sold is 437.5 million cubic feet. This exercise is relatively simple in terms of Excel. So what you see here on this page, and I kind of increase the size a little bit so that you can see it better. That's all we will need, so relatively simple. But then some formulas will be complex, so I'll make sure to walk you through them. So let's then go back to instructions. So to build the binomial tree, let's start with the current year gas price. And then in year 2, as we were told, it can go up by 50% of historical volatility. So the previous year multiplied by the cell F7, and I'll freeze F7 so they can move it around. Multiply that plus 1, so that will be an increase of 28%. Or it can go down by the same amount, so it can be the prior price divided by 1 plus 28% in cell C7, F7. And then I'll freeze F7. Now in this exercise, just to save us time, I can copy and paste formulas. By the way, this file has been protected just for the ease of grading. There's nothing magical, but you can't really type in anything on the side. It's been protected. If you're uncomfortable with that, you can go to protect and then unprotected. There's no password required. But for now, you can only type in these green cells. So these are the ones we'll be populating. But again, for the sake of efficiency, instead of me retyping these formulas for different nodes in the binomial tree, I will copy and paste, but be careful to freeze the right cells. So here, for example, in year 2 going up, I froze the percentage, but I didn't freeze prior year. So that means if I copy it for year 3 up, it will be based on year 2 times the same cell F7 with the volatility. If I copy it to the bottom, it'll kind of pick up year 2 down. In year 3 down, I would copy the formula from year 2 down. So it's kind of using the same logic, right? And then I can, from here, going up, I'll be copying and pasting formulas that are going up. And then going down, I'll just copy the formula from the prior year going down. So that's kind of just a quick way of populating the binomial tree if you freeze the right cells. So let me walk you through calculating the NPV here. You see the binomial tree for 5 years. And then the assignment is telling us that the cash flows will happen for 3 subsequent years after you start investing. So in the NPV calculation, we'll just take 3 years, but then let's look at the year 3 in this kind of higher scenario. So it'll be up in year 2, up in year 3. So the price in year 3 we can see is $3. So the cash flow in year 3 would be the initial investment, 2.5 million negative, plus gas sold 437 million cubic feet times $3 price. So that's the cash flow in year 3. In year 4, it's the same amount of gas produced multiplied by the price, and the expected price for year 4, if we are in this kind of up and up scenario, in $3 scenario in year 3, then in year 4, the expected price is the average of 383 and 234, assuming the probability of going up and down is the same. The expected price in year 5 would be the average of 5 different outcomes. So it'll be $1.83 in low case, $3 in low high or high low. So there's 2 ways to get to $3 in year 5, and then 490 is up scenario in year 5. So there's 4 different outcomes, but we'll take the average of them, and then multiply it by the gas produced. And then we'll have these 3 cash flows for year 3, 4, and 5, and we'll take a present value of that. So that's the essence of the NPV calculation that we'll be running in the 3rd step. It's one of the longer formulas, but the other ones will be much simpler. And then as I put in this formula, I will freeze certain cells which shouldn't be repeated, and the only cells that should move around when I copy the formula for different nodes in the binomial tree. So the only cells that should be moving would be the prices in the binomial tree. So everything else I should freeze in my formula, and that'll allow me to move it to the other nodes in the binomial tree. So let's start in year 3 up case. So I'll type equal NPV, and then it's asking me for discount rate. I'll put in F11 and I'll freeze it. Again, everything except for the prices, the gas prices should be static. So the next value is cash flow in year 3, and that one is negative 2.5 million. I'll freeze it, plus production 437,000. I'll freeze that, times the price in year 3. So that's in cell D19. And D19, I am not going to freeze. So that's the cash flow in year 1. The cash flow in year 2 would be net gas sold. I call it production. Net gas sold, freeze that, times average of price in year 4 up and price in year 4 down. So average of cells E19 and E20. And these ones, again, I'm not going to freeze. The cash flow in year 5 is the net gas sold. I'll freeze that. times the average of 4 different outcomes. So it's going up in year 5, going down in year 5 from year 4, or it could be going down year 4 and up in year 5. So include cell F19 twice, and then it could be going down in year 4 and down in year 5. So average of these 4 different outcomes. And that's really it. So the value is 753,000. These are all in thousands. And then I should be able to just copy and paste these values, just because, you know, they're kind of just replicating the prices in the binomial tree, and the other inputs are static. So these are different net present values of this investment, depending on the price of the gas prices in year 1, 2, 3, and also in year 4 and 5. We just don't show them here in NPV. So the prices in year 4 and 5 have been kind of lumped into the price in year 3. But then again, in year 2, you're just taking prices from year 2 to year 4, and you're taking present value of the cash flows in year 2 through 4. Let's look at the next step. You basically need to just take positive value. If the NPV is negative, that means that in that particular year, we will not be taking the project. So that's really the optionality. So we'll only pursue projects with positive NPV once we know that, you know, in year 2, the expected value of project is positive. Again, it's not guaranteed because we need further cash flows, but at least, you know, in year 2, we've got new information. In year 3, we've got new information versus year 2. So the formula is actually going to be quite simple. It'll be the higher of maximum 0 or the NPV at that particular point. So that'll allow me to take, and then I'll copy this formula in each value in the binomial tree, and this basically picked up only positive values. And the last step in this exercise requires us to present value these different outcomes. So let's say we are in year 3. The option value at that point is the net present value. And if it's 0, then it's, we don't have any option value. But in year 3, the NPV is the same as the option value. In year 2, the option value is the present value of the expected outcome in year 3. So it will, well, and then also there's, you know, the kind of if statement here, or a max formula. Basically, that says that the value would be higher of, would be max, higher of the NPV in year 2, or the present value of the NPVs from year 3. So it'll be higher of J17, or average, assuming the same probability of going up and down, or average of NPV in year 3 up, or down. And then I'll just present value. And then I can copy that down. And in the last step, to calculate the ultimate option value, we will take the maximum of NPV in that particular year, or present value of the outcomes, the option payoffs in year 2. So there'll be the average of cell J26, 319, and cell J28. That's 0 divided by 1 plus the discount rate. So the answer here, the final answer in this exercise is 131,000 is the option value. This is the end of the options class. This is a little bit unique methodology. There are different ways to value real options. We showed you binomial trees, but it's very customized approach, and you kind of need to figure out whether you have a real option before you apply this methodology. But this is an interesting case that basically shows you how to surface additional value through weighting and kind of making decisions as you get more information. Thank you for having me in this class, and I look forward to covering financial modeling with you next class. That'll be the real interesting topic, and we will switch next week when you have to submit your homework ahead of time. So make sure that you watch my lecture and the solution online, and then do your own exercise. So you'll see the instructions on Canvas, and I look forward to seeing you in class. Thank you.